Hello everyone, welcome to session 11. Till session 10, what all we discussed dissolution of firm on the ground that if we dissolve the firm today, immediately on a particular day, we're gonna realize all the assets and we're gonna make a payment. In that manner, we did it, but in practical, it is not so it is not so possible. Hence, a concept called piecemeal distribution will come into picture. Then let us see what it is. I'll read out the introduction for you. So the same thing, that is what in dissolution problems, we have seen that the assets are realized and the liabilities are paid out. Any realization loss is transferred to partner's capital account, and finally the capital balances are paid out. Here the problem of distribution of cash doesn't arise because we assume that all the assets are realized on the date of dissolution and liabilities are discharged on the same day. Because of this assumption, we came to know immediately the profit or loss on realization, which will be transferred to partners' capital accounts, and final balances due to them can be known. All the liabilities and partners' capital account balances can be paid off at a time as all the assets are transferred on one day. That is what I told you in the introduction. And till now what we did is we went on the assumption that on the day of dissolution all the assets will be sold and all the liabilities will be paid off. Further, however, in actual practice, this will be unrealistic. All the assets cannot be realized on the date of dissolution. Actually, there may be a time interval of even a few months between the realization of assets, and the entire dissolution process may take very long time. Assets are realized gradually, piece by piece. Hence, it is not possible to pay off all the liabilities at a time and to pay off the partners their dues from the firm. Now, the problem arises how to distribute cash among different parties and to whom the first payments will be made. So, in order to encounter this kind of a situation, the concept of piecemeal distribution came into picture. Then what is the meaning of this piecemeal distribution? In actual practice, the assets are not realized at once on a single day unless the business is sold to somebody. The partners expect a good price for the assets and therefore they gradually realize them depending on the market condition. Thus, the whole process of realization takes some time. That is, maybe a few months or sometimes a year or even more than a year. The process followed to discharge liabilities and claims of partners as and when the assets realized is called as piecemeal distribution of cash. Is nothing but, in simple words, on the day of dissolution all the assets can't be sold out and the money cannot be received on the same day, and on the same day we can't make a payment of all our outside liabilities as well as we can't make a payment of partners capital. So hence Assets may be sold in the market one by one or piece by piece. So hence the title given is piecemeal distribution of cash. Now, how to go for the payment? Then what is the order of payment? Let me tell you, at the outset, the first payment should be given to outside liabilities. See, whenever you realize the cash on sale of asset, first to whom should be paid? So first, the amount should be paid to outside liabilities. So from the cash available, first creditors, bills payable, bank loan and etc. So those liabilities which are considered as outside liabilities should be paid off. And remember, prior to these outside liabilities, realization expenses should be given due weightage. The cash is not sufficient, then those liabilities should be paid in proportionate to their claim. As just in our previous session we did with respect to creditors and bills payable, how when the cash is not sufficient, we distributed the cash between the creditors and bills payable proportionately. In the same manner, when the cash is available, first the cash should be paid to outside liabilities. If the cash is not sufficient, then in proportionate to their claim, the cash need to be distributed among outside liabilities. Once if you are done with your outside liabilities, the next comes is partner's loan. After this, outside liabilities, use the cash available to make payment of partner's loan. After partner's loan is been given, then you need to make a payment of partner's capital at the end. Now, in this case, I'm talking about partner's capital account. In this case, the important point to be noted is that the balances of capitals finally left unpaid should be in their profit sharing ratio, because these balances represents the loss on realization. Friends, when you prepare a realization account, when you get the profit or loss on realization, how you gonna divide that realization loss? You gonna divide that realization loss in their profit sharing ratio, profit or loss sharing ratio. Even in case of piecemeal distribution, when after preparation of this piecemeal distribution summary, at the end, if you get some balances left out, such balance should be in equal to their profit sharing ratio. That is what they are telling. Again, if the cash is distributed in the capital ratio, the unpaid balances of capital will also be in the same capital ratio instead of profit sharing ratio. Hence, to achieve the correct results, any of the following methods can be applied for returns of capital. So hence, just now what I told you is, instead of going with the payment of partners capital in their outstanding capital balances, we need not go for that. So that will at the end, when you get the balances in all partners capital account, that should be in proportionate to their profit sharing ratio, but not in their capital ratio. So in order to achieve this objective, we can adopt any one of the method. So first method is proportionate capital method. So I'll read out. According to this method, we have to calculate as to whose capital is in excess as compared to the profit sharing ratio of all partners. When cash is paid to that partner to the extent of his excess capital, the capitals of at least two partners will be in proportionate to their profit sharing ratio. Then further cash can be distributed to those two partners only in their profit sharing ratio to the extent of their excess capital. Now, after doing this much, you're gonna find the capitals of at least three partners will be in proportionate to their profit sharing ratio. So, till all the partners' capital balances come down to their profit sharing ratio, this process need to be continued. I'll give you an example. Say for example, A and B are partners having capitals of 30,000 and 20,000, sharing profits and losses equally. And they say A and B are partners. A has contributed 30,000 and B has contributed 20,000 as capital. But remember, their profits and losses, their profit sharing ratio is equally. Equal is nothing but when there are two partners, 1:1. I'll show you how to calculate this excess capital. So first, on the top, please mention their profit sharing ratio, as they told that equally is nothing but 1:1. Now, who are partners? A and B are partners. Now, their capital balances. On the top, they told 30,000, 20,000 they have invested. So 30,000 and 20,000. Friends, remember in this problem, B in order to take 1 rupee of profit has brought 20,000 capital. Once again I repeat, B in order to take 1 rupee of profit brought 20,000 rupees as capital. I'll ask you a simple question. When A is also taking only 1 rupee in a profit, then how much he should have brought in? So B 1 rupee profit ತಗೊಳ್ಳಿಕ್ಕೆ 20,000 ತಂದಿದ್ದಾರೆ. ಅದೇ A ಅದೇ 1 rupee profit ತಗೊಳ್ಳಿಕ್ಕೆ ಎಷ್ಟು ದುಡ್ಡು ತರಬೇಕಿತ್ತು? So that is what I have written here. A's capital on the basis of B's profit sharing ratio of 1:1. So ಇಬ್ರು ಪ್ರಾಫಿಟ್ 1:1 ತಗೋಬೇಕಾದ್ರೆ B's ಕ್ಯಾಪಿಟಲ್ 20,000 ಇದ್ರೆ A's ಕ್ಯಾಪಿಟಲ್ ಎಷ್ಟಿರಬೇಕು? 20,000ನೇ ಇರಬೇಕು. ಸೊ ಅಂದಾಗ, so what is the excess capital brought in by A? So excess capital brought in by A is 10,000. So now if you have a cash for the payment to partners capital account, first A should be given for his excess capital. Once A is paid 10,000 rupees back, then you can see what will be the capital balance of A and B now. After he is given 10,000, A's capital will come down to 20,000, B's capital will come down to, as usual, 20,000. So now, see, these two partners' profit sharing ratio is equal to their capital balances, 20,000 and 20,000. So this is what they are conveying under proportionate capital method or excess capital method we call it. So that is what is being explained in this problem. So with an example I have explained, but you need not worry. So while doing problem we can better understand this method. And the one more method we have is maximum loss method. So in this method, the difference between the totals of capitals at the time of distribution and the cash available, assuming that the remaining assets are not going to be realized, ಅನ್ನೋ ಕಾನ್ಸೆಪ್ಟ್ ಮೇಲೆ ಡೆವಲಪ್ ಮಾಡಿದ್ದಾರೆ. Say for example, for this one also I have an example. Capitals of A, B, C are 20,000, 30,000 and 15,000, and the cash available to them is 30,000. Then what is the maximum loss? So maximum loss that may happen to the firm is 35,000. So how we got this 35,000? So it's in a simple manner. Take the total of 20,000, 30,000 and 15,000. It is coming nearly the 30 plus 20, 50 plus 10, 65,000. Out of 65,000 capital, we have only how much? 30,000. Then what is the loss that we're gonna incur? We're gonna incur a loss of maximum 35,000. So after adjusting the maximum loss to the capital accounts in their profit sharing ratio, if we get negative capitals of any partner, such deficiency is to be transferred to the capital accounts of other partners in their capital ratio. Remember, is nothing but wherever after apportioning this maximum loss, if somebody is getting a negative balance, that is what is being considered as capital deficiency, and that should be borne by the solvent partners according to the decisions of Garner versus Murray. Then the balance represents the cash to be paid to respective partners out of the first available cash to them. The same procedure is to be repeated until the distribution of lost installment, the unpaid capital balances being loss on realization. And remember, if you adopt this maximum loss method or excess capital method, the balances at the end what you are going to get should be in their profit sharing ratio. So with this we're going to conclude for the day. So I have quoted the references, so you can, for further study material, you can click on the link, as well as you can refer a textbook written by M.B. Katko. So thank you.